Hello and welcome to the December edition of Pork Talk. 2020 has been a challenging year for a variety of reasons, and while the pork market has generally held up well, more challenges are now emerging. The SPP has been on a downward track for 17 weeks now and stood at 154 pence per kilogram in mid-November. A number of factors are contributing to the falling prices. A key issue at the moment is processing capacity in a number of abattoirs, where staff numbers have been reduced due to COVID-19 outbreaks. In the run-up to Christmas, kill numbers typically peak due to a mix of supply, strong demand, and the need to avoid logistical problems in the new year due to fewer kill days over the festive break. This year, it seems it could be difficult to reach the high kill levels we usually achieve. There are already reports of a backlog of pigs on farm due to insufficient capacity in previous weeks, and this may well increase as we head towards Christmas. Of course, high supplies of live pigs in relation to capacity at processors for them weighs on prices. We can see evidence of pig slaughter being delayed in the latest carcass weights, which continue to break records. The SPP sample averaged 88 kilograms in mid-November, and the probe measurement was 11.6, unusually high. Extra weight on pigs of course adds to supply availability at a time where demand is difficult to anticipate. While retail sales have been good this year, more than compensating for lost food service trade, we still don't know how Christmas will be celebrated this year and what this will mean for demand in the coming weeks. Prices in the EU also remain low, particularly in Germany, where the reference price for the start of November was only 119 pence per kilogram. The latest trade figures continue to show imports well below year-earlier levels, but the low prices for EU pigs probably still weigh on our prices somewhat. Processing capacity is also a challenge for the European industry, as well as difficulties on the export market. Germany has been unable to supply China since mid-September, and more recently a number of Danish plants have also stopped supplying China due to COVID outbreaks amongst staff. Our own exports are not immune to COVID-related difficulties, and volumes sold in September were similar to last year. This aside though, the outlook for Chinese import demand is now starting to ease off. Chinese pork production is expected to increase again next year, and while it is still well below pre-ASF levels, the volume they import is expected to fall as the price importers are willing to pay for product eases. This of course will drag on global pork prices and likely mean values here will remain lower than previous highs too. On top of all of this, we still face ongoing Brexit-related uncertainty. Right now, we still don't have a deal with the EU. Without one, imported pork is set to face high tariffs, which would most likely provide some price support here, even though our exports to the EU would also face high tariffs. This is because we are such a big net importer of pork. Even with a deal, the extra administrative costs of importing pork may also offer a little support. This will be vulnerable to being counteracted by any potential rise in the value of the pound though. The pork market situation could become volatile at the moment, depending on how abattoir throughputs hold up, Chinese import opportunities develop, the coronavirus pandemic unfolds, and also any Brexit-related announcements. We'll of course continue to monitor what any changes mean for you as they unfold. To keep up to date, check out the market analysis section under pork markets and prices on the AHDB website, or subscribe to Pork Weekly for the latest updates in your inbox every week.